Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and tonight we are going through a monthly market update for the property market for July 2024. Lots to get through tonight. A few things happening through the month. So, to kick it off, the Australian CoreLogic dwelling price month on month, we saw again another 0.5%, so 0.5% increase in July. So this is now the 18th consecutive month of increases. Not all markets perform together. Historically, Sydney and Melbourne outperform in the first half of the cycle of the 18-year land cycle. Then Brisbane, Perth, Adelaide outperform in the second half of the cycle, like what we are seeing now. So Perth, just in 1 month, 2%. Adelaide, 1.8% increase. Brisbane, 1.1%. On the other side of the coin, you got Hobart declined by 0.5%, Melbourne declined by 0.4%, and Darwin 0.2% decline. So not all markets are running at the same race. Sorry, not all markets run the same race. They are running at different stages of their own property clock. So the mainstream is drawn into markets that are well set in their upturn, as people tend to flock in with FOMO once a market has become well known that it's in a boom. We are now seeing this now a lot in Brisbane. So properties are selling within a week of hitting the markets, becoming very competitive to get a good deal, very hard to get under bank value, very hard to get under the RP data estimates. So this is what we like to specialize in. Number one, getting under bank value and under RP data. It's becoming fewer and far between to get this now in Brisbane, Perth, and Adelaide. You almost got to pay overs. So we are advising our clients, and personally, I'm not buying up in Queensland anymore, unless if a deal comes up like a block of units where there's less competition. But blocks, units and villas and houses, they're all going for over bank value. The market is well and truly set on its course. You ideally want to get into a market before it really gets into the upturn groove. So where we're seeing that now is down in certain pockets in Sydney and in Melbourne and their respective regions, so New South Wales and Victoria. So we don't like buying in booming markets. Rather, we like to buy in suppressed markets ahead of when they're yet to go through their next boom, because you can then negotiate good deals. The properties sit on the market for 60, 90, even larger assets like blocks of units can sit on the market for 6 months, 12 months. So you've got time to negotiate good deals. Then you can squeeze the vendors down to get a good price, get good value, get well under bank value with a high yield, and then you're reducing how much debt is required to put into that one asset. If you're buying in a suppressed market, obviously you got to hold on to it until it then goes through its next upturn. But if you're making money on the way in, if you're buying it for under bank value, you don't necessarily have to wait until the market really kicks into gear. Whereas if you're buying in a heated market, like what most people like to do, because they get sucked into the FOMO and all the rush of, the market going up, you'll pay overs, and then you're backing that the market is going to continue to keep rising. So for us, it's more risky to be buying now in Perth, Adelaide, and Brisbane, because they'll top out at some point, probably around 26, 27, then they might come off 15, 20%, have a slowdown, and then they'll go through a protracted long period of flat to negative growth. So I tell our clients to buy in markets that have been going flat to backwards for a long period of time. So we're now seeing certain pockets in Sydney and Melbourne that we're picking up properties now for cheaper than what people bought them for 8, 9, 10 years ago. So that's a good indicator. When you can buy a property that is for the same price or less than what someone bought it for 8, 9, 10 years earlier, it's only a matter of time where it'll get into its next growth, significant growth upturn. So I was buying up a lot in Brisbane, Perth, Adelaide, in Brisbane, sorry, around that 2018, 2019, where no one was talking up Brisbane. It was flat for a good 10, 11 years, only until 2022, where it's really started to pick up, and now it's mainstream that everyone wants to pile in and get in and pay over. So we're now seeing that in the data. This is all based off the 18-year land cycle. Australian building permits still at low levels, lowest in over a decade. So this is talking supply. Until the approvals start to increase, that will then be a leading indicator that more supply is going to come onto the market by way of new developers building new blocks of units or houses, doing greenfield sites, so buying a farm and doing subdividing into 3,000, 4,000 lots of land, selling off the lots of land to the mums and dads to build new houses. So that's new stock, either houses or high-rise apartments. Lowest level since over 10, 11 years. So what this means is when there's a restriction of supply and there's net overseas migration that's still coming through very strongly, and they're all wealthy migrants, there's constantly going to be a restriction of how much supply of new stock is on the market versus the demand, so that prices will keep going up. So what's holding the Australian building approvals? There's a number of factors. Cost of materials, cost of labor still elevated. It is coming back a little bit, but it is still pretty high. The requirements for DAs, it's always been tricky to get DAs over the line. Australia generally has a anti-development, so to speak, culture. We've got so much land, so much opportunity to build, but the restrictions around the planning regulations, the environmental regulations is anti-development, versus in other countries like in America, where you can pretty much build wherever you want to build. So there's supplies constantly meeting the demand, so the prices stay lower. In Australia, it's the opposite. Very restrictive of supply, and demand is through the roof. We're one of the leading countries in the world for high net worth migrants. So as long as these high net worth migrants keep coming in, propping up the economy, pushing the GDP numbers, so the federal government can stay in power, whoever that is, they'll always drive a high net migration because it ultimately keeps GDP in positive. We're always going to have demand outstripping supply. Prices are always going to keep driving to that next level. So that's good as a property investor. Good to see that these levels are low. It means that there's always a high demand for the existing stock and a more scarcity demand for the existing stock. Rental vacancy rates. So this then shows that how much the existing stock has been soaked up. So with less building approvals, less building, less development, less new construction, adding more dwellings onto the market, and having a high net worth migrants coming in, it's soaking up all available rentals. It's pushing down the vacancy rates pretty much across the country. So quite interesting, actually. The first half of the cycle, Sydney, Melbourne outperformed. So between 2011, and this is reflected in this data here, if you can see it, 2011, 12, that's when the current cycle started, lead up until 2018, 2019. If you look at Sydney and Melbourne, the two blues, light blue Sydney, dark blue is Melbourne, they had relatively low vacancy rates until around 2019, where it then increased. So Sydney and Melbourne historically outperform in the first half of the cycle, and then they don't perform as well in the second half. That's reflected in the vacancy rates. On the other side of the coin, Brisbane, Perth, well, Adelaide's not on here, but just Brisbane and Perth, they don't perform well in the first half of the cycle. So first half of the cycle, they've had high vacancy rates. So high vacancy rate is anything above 3 is high. Anything around 3 is a well-balanced market. Anything below 3 is a very tight vacancy rate. There's literally, if it gets below 1, or like where there are in now Brisbane, Perth, that is very tight. Like some of the regions we bought up a few years back, they've got literally 1 to 2 handful of rentals in the town when they've got 15 to 16,000 population. So very tight, hardly any rentals available, which is driving rents because you can pretty much dictate what price you want, which then ultimately gets capitalized into a higher price. So as you can see, in the second half of the cycle, we've got very low vacancy rates for Brisbane and Perth, which are then now outperforming in the second half of the cycle. Sydney and Melbourne are coming down as well. So they're primed, so to speak, in terms of buying in these macro markets for the next upturn, which would be due around 28, 29 is where I would see Sydney and Melbourne then taking off for its next significant bull run, which will be the lead in the recovery in the next cycle, the next 18-year land cycle. Next slide. So the RBA. So I was actually predicting the RBA to put the cash rate up, and I was quite surprised that they held the cash rate. Reason for this is inflation rose to 3.8% to the June quarter, 2024. So even still, they decide to hold the cash rate. So I think it's a bit of more so peer pressure, and they're probably hoping that it'll come down naturally. Inflation, as global inflation is cooling. However, other central banks like UK central bank, the US central bank, and the New Zealand central bank went a lot harder earlier with the cash rate. So they got the cash rate up to 5-6%. Australian RBA took their time and have held it for nearly 11, 12 months now at 4.35%. So I personally think it's too high. Sorry, the cash rate is too low in order to bring inflation back down to the 2 to 3% band. And the RBA is forecasting that inflation is not going to return to the target range, so the top end of the range, so around 3% until 2025, and approach the midpoint, so 2.5%, in 2026. So basically saying that the cash rate is probably going to keep elevated, and there's probably another few notches up until the midpoint of 2026, which is quite interesting, because if you know your 18-year land cycle, that is when the market is due to top out before we go through the next land-driven downturn. Brings us to the 18-year land cycle. We're on the yellow marker. So based off the higher inflation data and even the RBA's forecast, rates are going to stay where they are. There's definitely, I don't think any opportunity until the market tops out in the second quarter. So based off Philip J. Anderson's work, he's saying April 2026 is going to be the peak of the market in the US. Australia historically trails 6 to 12 months behind the US. So we're watching the US to see what is happening over there. And the RBA is saying that they don't see inflation coming back into the band 2.5% until 2026. So if you overlay this information, you can visualize the structure of the 18-year land cycle playing out and what is more likely going to happen. Rates going to stay higher for longer until probably mid to late 26. The market will turn south through the next land-driven downturn, which was like a 2008 GFC or a 1991 recession we had to have. And if you know your history, every second land-driven downturn is a large one. So we pretty much sailed through the GFC, but we didn't sail through the 91 recession we had to have. If you ask any baby boomer that was holding property or had a large loan during the 91 recession we had to have, where interest rates got to 17, 18%, there was a lot of pain and a lot of blood on the streets. Not saying that the cash rate will get to that level again. There's too much debt in the system. There's too many other forces at play. But I can definitely see the cash rate getting up to the even 5-6% mark before it then will get dropped back to zero before you know it. So what does this all mean, property investors? I'm stacking my cash, refinancing, drawing equity out. The next couple of years, also banks will probably start loosening lending policies or finding more creative ways to keep lending because they need to keep their loan books turning over. They're in the business of writing loans. So they'll keep trying to figure out ways to keep lending going. And if you recall, pre-GFC, especially in the States, very loose lending where you could pretty much go into any bank and not really prove you got a job and get $1 million loan drawn up. Not saying that that would happen necessarily in Australia. Australia's got a pretty robust banking system, but don't be surprised if you start seeing banks start lending against cryptocurrency such as Bitcoin, using that as security. That will then push the lending market to the next level, which will ultimately drive the market to its peak. And then once the market turns, it'll all come tumbling down. So I am refinancing, drawing equity, cashing up, getting as much equity, as much cash out of the portfolio as possible to firstly protect my holdings against high interest rates. So you need to be able to sail through the high interest rate environment. So using the equity to service the higher loans, but then also be cashed up and ready to go for when the market turns. Because the deals are already starting to pop in Sydney and Melbourne. Brisbane, Perth, Adelaide, deals aren't really there. Historically, they're booming now, and the CoreLogic data reflects that they are continue to boom. They're well and truly shippers, well and truly sailed. You wanted to buy into those markets between 2018, 19 to 2022, and then add value now by way of renovation or development. But what you want to do now, if you've got holdings in Brisbane, Perth, Adelaide, is to draw equity, use that equity, get the cash out to firstly protect yourself against rates. And then if you're in a strong enough, stable position, then right now is the time for the next decade, probably, or maybe even 7 to 8 years, to start deploying capital into Sydney, Melbourne, and their respective regions to capitalize on their next growth cycle, which will commence around 2028 and onwards. But between now and 28, the deals are there to be had. So I've recently bought a block of 4 units down in Victoria, and I'm going to be tic-tacking back and forth between Sydney, Melbourne, regional Victoria, regional New South Wales for the next, I would say, at least until 2030, and then reassess. So what's that? Another 6 to probably 8 years. At that point in time, it will then be seeing what's happening in Brisbane, Perth, Adelaide again to then capitalize on the second half of the next cycle. So counter-cyclical, not getting carried away with the herd and doing what everyone else is doing and talking up the Olympic Games and all that sort of bullshit. Because yes, the Olympic Games is nice and all the infrastructure spend that's going in there, but really that's the icing on the cake. You want to invest, you want to bake the cake in before it goes through its growth cycle. You'll make your most money having knowledge of this 18-year land cycle. And then sure, if you got Olympic Games going in or get new roads and bridges and upgrades and all that sort of stuff, that's great, but that's the icing on the cake. You don't invest for the cream on the cake or the icing on the cake. You need to build a solid foundation, and then any of that happens on top is a bonus. That's how I look at it. And the only way to build a solid foundation or bake your cake is buying in the right market at the right time and getting the right price and not overextending yourself and putting too much debt into one property. So I only really like to buy properties between that 250 to 350 mark. If you're going above that, only if you're going a block of 2 units or 3 or 4, but sticking to that same concept. If you're buying a block of 3 units, you only really want to spend max sort of 750 grand for it. You don't want to start spending millions of dollars because that's where you're getting too leveraged into one location or one asset with a too low a yield, and that's where you can get yourself potentially unstuck. Whereas into the Sydney and Melbourne markets now, because there's certain pockets that have been flat for a good 8, 9 years, the downside risk is pretty much minimal. If you can pick up a property for 300 grand that has been going nowhere for 8, 9 years, and it costs 450, 500 to build that property these days, so you're getting under bank value, you're getting under replacement costs. It can't really go any further south. It's only got upside. And even when we go through a GFC like event like we will, the lower end of the market always outperforms. People downsize, they can't afford the $1 million house, and they sell the family house, and they sell the fancy car, and they need to sort out for affordable accommodation. They go for the smaller assets, 1 and 2 bedroom units, or the regional house that's affordable. That's demand, lots of demand into those types of products or those assets. And then when everything else is coming off the boil, being the top end, the $1 million plus properties will have a 20-30% cool down or drawback in the next downturn. The bottom end of the market is going up. So I found this during COVID. A lot of the properties that I bought, pretty much everything was going up when the top end was having a bit of a slowdown, probably only in 2020, 2021, before it started to take off again. But the bottom end of the market always outperforms even in a downturn. Cash rate. So a little bit more on the cash rate. If you overlay the 18-year land cycle on the cash rate, you'll find what happened between the last land boom, between 2002 to 2007. Cash rate went up 13 or 14 times from 4.25% at the bottom in 2002 to 7.25% in 2007 or 2008. So we're in the equivalent of around 2005, where yes, we've been flat for a while at 4.35%, but based off history, based off Phil Anderson's work, based off the RBA saying that there's relatively no possibility that the cash rate's going down until 2026. Inflation's still at 3.8%. It's not between the band. The only way to get down is to jack the rate up. So don't be surprised if the rate starts to go up a lot now or a few times between now and the peak. And then once it tops out, 26, 27, bang, we'll be back down to zero before you know it or close to, which will then be a good time to lock in rates again for as long as you can at a low rate. So what also gives me Confidence or my beliefs that I believe that inflation is going to remain elevated for the next couple of years is US politics. Sort of was skipping across a little bit, but I'll go back. So US politics, Trump. So there's been a lot that has been happening in US politics this month. An attempted assassination on Trump, which the marketing genius really used to further boost his image as a strong leader. Like, look at him here. That is marketing 101. Biden threw in the towel on the race, and now Harris has now brought a new dynamic, which is winning over more buyers, more voters or polls, as now showing up a more competitive race for the White House. So, I mean, either way, the 18-year land cycle is going to still run its course. But, I mean, I'm a property guy. I'm not trying to, I guess, push politics on I guess the information I put out there, but I'm rooting for Trump. For the reason for that is his policies. He's a property guy. He'll give the markets globally a sugar hit. It'll be the biggest boom in history the next couple of years. Reason for that, tax cuts. He's already talking up doing bigger tax cuts than what Ronald Reagan did in the 80s. That kicked off massive property boom, massive economic boom. Also very inflationary. People have more money to spend, they'll spend it, they'll take out loans, and they'll all filter down to the benefit of land price. It'll push the market to its highest of heights, cutting regulations such as banking regulations. So putting the onus back onto the borrower to make sure that the borrower can borrow the money rather than the bank. So Obama brought in these regulations after the GFC to make sure that the banks were doing their assessments on the borrowers so they could afford it. That's what Trump will cut because he's a property guy. He knows if lending starts to kick into gear, the economy will be roaring, stock market will be roaring, property prices will be roaring. He'll drill oil to lower energy costs to ultimately lower inflation. Energy cost goes to everything. So yes, I guess it's anti, I guess, the environment, and it's not good for the environment, oil, but the economy, another story. So by drilling oil, reducing fuel price, so diesel, petrol goes into transport costs. So if there's higher petrol and diesel costs, that cost then gets passed on to the consumer of transport. So food, clothing, everything needs to be transported around the world. Uh, Planes, everything that needs fossil fuels. If there's high energy costs, that then gets pushed onto the end consumer, which is pushing inflation. So him by drilling oil will bring down energy costs, will bring down inflation. So then it will allow him ultimately what he wants to do is cut the Fed funds rate. And he won't be able to do that, cut the Fed funds rate. Well, he'll probably try and kick out Jerome Powell and get someone else in there to that he will have more oversight, so he'll be able to tell them what to do. But he won't be able to maintain the Fed funds rate at a low rate and keep it low if inflation's out of control. So he'll be drilling oil to try and bring down inflation. So all these will ultimately filter down to the benefit of property and land price, and it will send it through. We'll be going through the biggest boom in history, which will ultimately, every boom will be lead into the inevitable bust, biggest bust in history. So it's like a big tidal wave. You got to ride the wave and don't get taken out by it. So all this will be happening at the midst of the winner's curse, the last two most speculative years of the land boom before we enter the land-driven downturn. So another thing that's quite interesting too is the Australian unemployment rate. I look at this through a lens of the 18-year land cycle. So once the unemployment rate starts to tick up, which it is, it will then have in the next couple of years, it'll then shoot. So this is 91 recession. Unemployment got right down to 5.5, 6%, bang, up to 11%. This is the first half of the cycle of the previous cycle. Little bit of a rise in the dot-com bust, 2000, 2002. Second half of the cycle, unemployment went right down low to about 4.5%. That was the GFC, up to about 5.5%. And then first half of the cycle didn't get very low. And then COVID spike. We've now recovered from COVID. This is the second half of the cycle and it's starting to rise. So historically, it literally went up straight away, bang. But if you look at the US, it's a gradual increase and then more of a gradual increase. So same period. So the 1989 peak before we went through the land-driven downturn in the previous cycle, 91 recession we had to have, and then the recovery, the dot-com bust, recovery after the dot-com bust, and then the GFC, up to 9, 10% unemployment. And really, we've had the longest bull run in many years, stock market and property. And that's reflected in the unemployment rate. The economy is growing strong in the US. COVID, I guess, big spike, but more so because there was a shutdown, people couldn't go to work. So a lot of businesses were trying to shore up their balance sheets by sacking a lot of people, but then that corrected relatively quickly. And now it's starting to rise again. So this is quite interesting. It's probably on par with Phil J. Anderson's work that the market will top out in 2026, Q2, April 2026. So the curve has started. So the deals will be there to be had. Q2 2026, there's not too long to go now. What's that? Less than 2 years away before we hit the peak of the market. So rates will stay high, need to hang in there till mid 26, and then unemployment will spike, get up to probably 10%. So the other risk is not just interest rates you got to keep an eye on, but also unemployment. So if you're carrying a lot of property and unemployment gets up pretty high, tenants may lose their jobs. So you may go through a period where you might lose a couple of tenants. During COVID, I lost two tenants. I mean, residential property is pretty easy to get another tenant, especially the more affordable stuff that we like to buy, blue collar, working class, affordable properties. They're in high demand. So in COVID, I replaced the tenant within a week, and the other property took me about 3 or 4 weeks. So it's not like commercial assets that will stay vacant for probably the entire land-driven downturn, 3 to 4 years, until businesses start to recover and then that's when you'll get your tenants back in the commercial space. So it'll be quite interesting to see how all the commercial investors go during the next land-driven downturn, because I know people that have a lot of commercial property. One close friend of mine has pretty much all 80-90% of his portfolio is commercial, and his vacancy rate during COVID went down to 10%. So he lost 90% of his rental income during COVID. It's now back at 95% occupied. But that's what you got to keep in mind, is commercial assets typically get pretty well hit hard during the land-driven downturn. They can even lose up to 70 to 80% of their value, because the value of a commercial asset is connected to the earnings, the rents that is generated. So if it doesn't have a tenant, then it's not worth as much as it was with a fully occupied. So interesting times ahead are coming. But residential property, you want a good solid foundation portfolio of residential property before you get into commercial, because yes, you'll have lower rental yields, but the vacancy rates are definitely a lot less, max 1 or 2 months, than a commercial asset. Anyway, that's it for tonight. Just a disclaimer, this content is general in nature and is by no means general or personal advice. I'm not a financial advisor. This is by no means legal, tax advice either, or investment advice. I operate as a buyer's agent. If this resonates with you, I'll put my details in the comments below. Hit me up. Happy to chat anytime about your goals, our services, and how we potentially could help you. Remember to like, subscribe, share this content to anyone that you think it would be value to. Put any comments below. If you want to see any other content, give me some ideas. I see these market updates are getting a bit of attraction, so I'll keep these going. I think it's quite interesting as we go through the 18-year land cycle and see how it all plays out and what all the information means in relation to the 18-year land cycle, and where to potentially take action at a macro level. I'll give you that information. You can take it with a grain of salt and kick goals by yourself, or you can always reach out to me for a hand. Just remember, now is more important than ever to be cautious with your investments, as people will become emotional, reckless, not pay attention to the fundamentals, and may end up getting themselves burnt when the market turns post 2026. You can always contact me via my email, geordie@williamsrealestatecompany.net. I'll put the details below with any questions, queries, feedback. Until next time, thanks for watching. I will see you then.